Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A Fed shockwave triggers market chaos as rate cut dreams evaporate, sending the Nasdaq plunging 2.3%. This is your wake-up call. Is a major correction storm now brewing? Second, Buffett's $4.3 billion alphabet bombshell hides a deeper truth, the secret war on China risk. While Wall Street cheers the massive Google bet, Berkshire is quietly dumping Apple. Is this the ultimate de-risking play before a geopolitical storm hits? Finally, crisis looms. The McDonald's surge masks a terrifying reality. The trade-down effect has hit the wealthy, a classic recession signal. With youth unemployment skyrocketing, is the consumer economy about to break? Warning, today marks a pivotal shift as the Federal Reserve's hawkish pivot sends a shockwave through the markets. The S&P 500 closed down 1.7% and the Nasdaq plunged 2.3%. This is your wake-up call! The drama unfolded after Fed Chair Powell's statement that a December rate cut is not a foregone conclusion. Investors, I'm telling you, this is a game changer. Why is this so critical? The Fed's stance sent ripples through the market, altering the landscape for interest rate expectations. The probability of a December cut plummeted from 52% to as low as 42%, leaving investors scrambling. This isn't just noise, it's a fundamental shift. We're looking at a prolonged period of higher interest rates, and the implications are vast. Let's break it down. First, the policy layer. This hawkish Fed stance is rooted in stubborn inflation data. The November CPI is estimated at 0.31% month over month, with core inflation sticky at 2.95% annually. This persistent inflation justifies the Fed's position, making rate cuts less likely. Next, the money flow layer. With the 10-year Treasury yield jumping to 4.08%, capital is fleeing growth stocks. The VIX is up, signaling heightened market anxiety. Finally, the valuation layer. High multiple tech stocks are under pressure. The tech-heavy Nasdaq's decline indicates a valuation reset is underway, impacting companies like Microsoft and Alphabet. Listen to me. Act now, reduce tech exposure and pivot to financials and energy sectors that benefit from higher rates. In the sectors, tech was the day's biggest loser, with the XLK down 2.5%. Microsoft and Alphabet both took hits, with Microsoft down 2.8% and Alphabet down 3.1%. In contrast, the energy sector, represented by XLE, rose 0.3%, buoyed by geopolitical tensions impacting oil prices. Chevron and ExxonMobil are seeing gains as oil prices rise due to Middle East tensions and Ukrainian attacks on Russian oil infrastructure. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Here's what you need to do. Short term, 1 to 2 weeks, cut your tech holdings by 15 to 25% and shift into financials. Increase your allocation to XLF by 3 to 5% as banks benefit from wider net interest margins in a high rate environment. Medium term, 1 to 3 months, build positions in high yield dividend stocks. Altria, MO and Verizon, VZ, offer yields of 7.20% and 6.85%, respectively. Use these as a defensive anchor against market volatility. Hedge your bets with SPY, put options or inverse ETFs like SQQQ to protect against further downside. Risk controls are crucial. If the Nasdaq breaks below 420 points, accelerate tech reductions. Conversely, if the 10-year Treasury dips below 4.0% alongside a VIX drop, consider reloading growth stocks. For those with advanced capabilities, use options to hedge. Sell QQQ straddles to profit from post-earnings volatility compression. This is your roadmap. Navigate it wisely. The next catalyst is NVIDIA's earnings report on November 19th. This will be pivotal for tech sentiment and AI sector outlooks. Watch closely, as any guidance below $60 billion for Q4 could trigger another tech sell-off. Meanwhile, keep an eye on inflation nowcasts. An uptick could solidify the Fed's hawkish stance, further pressuring growth stocks. Time's ticking. Let's dive deep into today's critical market dynamics and prepare for what's next. The story begins with a decision that caught everyone by surprise. Warren Buffett's Berkshire Hathaway has just revealed a new $4.3 billion stake in Google's parent company, Alphabet. For an investing giant that has historically been reluctant toward high-growth tech, this move is sending shockwaves through the market. This isn't just about buying a popular stock, it's a move that could redefine value investing itself. You see, the key here is a concept Buffett loves, the economic moat, a company's sustainable competitive advantage. What this investment suggests is that in today's economy, a dominant AI platform is the new modern-day moat. Alphabet's massive lead in search, data, and artificial intelligence creates a powerful barrier that is incredibly difficult for competitors to overcome, making it a generator of long-term cash flow. Alphabet has been a standout winner this year, with shares rallying 46%, driven by strong demand for AI. And this isn't just a random bet. Years ago, Buffett himself admitted he blew it by not investing in Google, even as he saw its advertising power firsthand. Now, Berkshire is making a massive course correction, making Alphabet its 10th largest equity holding. Interestingly enough, this move is likely a glimpse into Berkshire's future. The decision was probably driven by Buffett's investment managers, Todd Combs and Ted Weschler, who are known to favor technology and growth-oriented companies. It gives us a leading indicator of a strategic pivot for the post-Buffett era, where the portfolio becomes more tech-heavy. We see this officially in what's called a 13F filing, a quarterly report revealing the holdings of large institutional investors. But that's not the whole picture. The real turning point is what Berkshire is selling. The firm continued to trim its massive Apple stake, cutting another 15% this quarter. This comes after a head-turning selling spree in 2024 that slashed 2/3 of the shares Berkshire held in its single biggest investment. The consistent selling of Apple, even while the company performs well, may be a quiet signal about geopolitical risk. After all, Apple's business is deeply intertwined with China. Over 95% of its products are assembled there, and the Greater China region accounts for about 16% of its total revenue. For a long-term investor like Berkshire, this heavy exposure to a single country's supply chain and market represents a significant risk, especially amid rising US-China tensions. This move suggests one of the world's savviest investors is actively de-risking its portfolio from that specific vulnerability. The selling doesn't stop there. When we place this Alphabet buy alongside Berkshire's other moves, the contradiction becomes clear. The firm also dialed back its Bank of America stake and has now been a net seller of stocks for 12 consecutive quarters, dumping shares as the tech-driven bull market climbed higher. This suggests a major long-term sector rotation. It's a bet that the next wave of economic growth will be driven more by AI-powered productivity gains than by the traditional credit cycle that banks depend on. This aligns with recent data from the Federal Reserve's survey of loan officers, which shows banks are still tightening their lending standards, potentially creating headwinds for the financial sector. Furthermore, being a net seller for 12 straight quarters while building up a record cash pile of over $347 billion is a powerful contrarian signal. There's a famous metric called the Buffett indicator, which compares the total stock market value to the nation's GDP. Historically, a healthy level is around 80%. Today, it's over 220%. Believe it or not, this suggests Berkshire believes that at current high valuations, good investment opportunities are scarce, and it's better to hold cash and wait. With the 95-year-old Buffett stepping down as CEO at the end of the year, this isn't just a portfolio adjustment, it's a clear signal. The key things to watch are Berkshire's future 13F filings to see if this pivot toward tech and away from China-exposed assets continues. This shift could impact everything from stock prices to the long-term value of bonds as investors reevaluate where the real opportunities lie. As Berkshire Hathaway enters a new era of leadership, the playbook that defined an entire generation of investing is being rewritten right before our eyes. We were just talking about one of the world's biggest investors betting on a slowdown. Now, let's shift our focus to where those signs are showing up on Main Street, starting with the fast food industry. A recent report shows a nearly double-digit surge in traffic from high-income diners. McDonald's CEO Chris Kempczynski confirms it, saying, "Value matters to everybody as his company gains market share with wealthier consumers." Now, this isn't just a quirky trend. Economists call this the trade-down effect, and it's a powerful leading indicator. This really challenges the long-held narrative that wealthy shoppers are resilient and will keep spending on premium goods no matter what. The fact that this behavior is now spreading to high-income consumers signals a potential slowdown in broad-based discretionary spending, which could threaten corporate earnings and even GDP growth forecasts. And it's not just fast food. The CEO of thrift store chain Savers Value Village says its more affluent customer group is growing, calling the trend a perfect outcome. It's a seismic shift backed by a recent survey showing 24% of people earning over $100,000 a year plan to spend less this holiday season. They're not just buying fewer things. They are actively switching to less expensive brands and lower cost retailers. However, if you zoom out, you'll see another layer at play. While the wealthy hunt for bargains, an entire generation is pulling back. Gen Z and millennials are spending less as they face a slowing job market and the resumption of student loan payments. And this isn't just a feeling. It's backed by hard numbers. The youth unemployment rate for workers aged 16 to 24 just rose to 12.5%, the highest level in over 2 years. Now, get this. Youth unemployment is often seen as the canary in the coal mine for the broader economy. Younger workers are frequently the first to be let go, so their struggles can be an early warning of a wider slowdown. Fast casual chains like Chipotle, Carver, and Sweetgreen are feeling the pain, reporting that diners aged 25 to 35 are not visiting as frequently. Chipotle's CEO directly links this to unemployment and slower wage growth for the cohort. The situation presents a fascinating duality. On one side, value-oriented giants like Walmart and Dollar General are positioned to win by attracting deal hunters from every income bracket. Recent data shows that 75% of Walmart's market share gains have come from households earning over $100,000 a year. On the other side, it exposes the vulnerability of retailers like Target and Best Buy, who are losing market share as even their traditional customers trade down. The battle lines for the holiday season are drawn, but there's another invisible headwind that could affect prices for everyone. The re-emergence of tariffs on Chinese goods is putting immense pressure on retailer profit margins. Right now, many retailers are choosing to absorb these extra costs to keep prices competitive. This strategy isn't sustainable though. After the holidays, they may be forced to pass these costs on to consumers through price hikes, which could potentially reignite goods, inflation. Some brands like Coach and Ralph Lauren are bucking the trend, attracting younger shoppers with strong brand identity. Here's where it gets interesting. In a tough consumer environment, strong brand equity, which is essentially the value premium a company gets from a well-known name, is becoming a key survival tool. Companies with powerful brands, like the sneaker company On, can maintain pricing power. On reported a nearly 25% sales increase and noted its affluent customers were not deterred by price increases. This suggests the slowdown isn't hitting everyone equally, creating clear winners and losers based on the intangible power of a brand. But the dominant story is a fractured consumer landscape. The playbook is being rewritten, with the winners being those who can capture the dollar of a consumer who is either seeking value by choice or cutting back out of necessity.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.